Hello and welcome to Lighthouse Outlook, the podcast dedicated to guiding you through the complex landscape of investing. I'm your host, Dave McNichol, president and founder of McNichol and Associates Asset Management. Here at Lighthouse Outlook, we delve into the essential strategies and insights necessary for making safe, informed investment decisions. Our goal is to equip you with the knowledge to confidently navigate the financial markets. Each episode will cover crucial topics from market dynamics to innovative investment strategies, all designed to help you secure your financial future. Lighthouse Outlook is available on all major podcasting platforms, including Apple Podcasts, Spotify, and YouTube. For those looking to enhance their experience, I encourage you to register on our website for free. By registering, you gain access to exclusive content and the opportunity to participate in live podcast events where you can engage directly with our expert guests. So subscribe today, become part of our community, and take the helm of your investment journey. Let's dive into today's episode. Tell us about your past, Raoul. Where'd you come from? Where were you born? Just tell us a little bit about yourself.
Yeah, so I was born in England, hence the accent. My father was a first-generation immigrant from India. I met my mother, who was Dutch. She was a Dutch au pair, and he was a student. Ended up working for Xerox, running marketing in Europe. But they met on a blind date, and I was one of the outcome. Myself and my sister. We lived in England for most of our lives. We actually moved to India for a short period of time. Dad lost his job back in, I think it was 1980, 81. And they said, well, let's try going back to India. It was too much of a culture shock back then. I mean, there was one TV channel at that point. We have to have a smuggler to come and bring Western goods, stuff like that. India's changed a lot since then. So I grew up there. I worked in finance my whole life, working for many of the big UK investment banks, and then ending up at Goldman Sachs, where I kind of ran a hedge fund sales business and equities and equity derivatives, then ran a hedge fund, did all of that stuff, then moved to Spain. I took the lifestyle choice of I want something that has a really high quality of life, and the finance industry is a tough industry to be in, and I wanted a change. So I decided I was going to write macroeconomic research and live on the Mediterranean coast of Spain, which was brilliant. I mean, I thought I was going to be an olive farmer or something of that sort. It didn't really work that way, but that was my dream. I was going to go there and, have my olives and my vines and live that life. And then I ended up randomly in the Cayman Islands. I built a house there on the beach, and in Little Cayman, an island of 150 people, and then just started Real Vision from here, and then ended up staying. And so now I live in the Cayman Islands. I still have a place in Spain, a place in Miami as well, and move around a bit. But yeah, my home is now a small, salty, hot rock in the middle of nowhere.
Okay. Great. And, well, sorry to interrupt. I forgot to start us off properly, and my apologies to our marketing team. They did some work here, so bear with me. I'm just going to do an introduction. We've already done that, so thanks for putting up with that, Raoul. You are our first person on this podcast format. We've been doing webinars for years, and we're told that these are more of a friendly way for people to understand about the world and the markets and so forth. So, okay, that's great about your background and where you are in the world, and I'm sure you're not stuck on that rock 12 months a year. I'm sure you're traveling all over the place. Maybe we should just jump right into it, sort of talking about the world and your macro outlook. Remind the audience about what you do in the macro space and where all that information comes from, because it's voluminous. From time to time you share it with us, and it's literally like reading a book every month. So you must have a strong team putting all that together. So maybe just walk us through how you collect your data and how you do your macro.
So as you mentioned, I do a lot of things. But the epicenter, the DNA of everything I do is something called Global Macro Investor, which is my research service that's aimed at institutions, hedge funds, high net worth investors, family offices. I've been writing that for 20 years. It's probably got, well, it has got the best proven track record of any research service in the world. I don't know how I've managed that, but Luckily, somewhere along the route, I've done some right things. I've made some big mistakes too. So it's not like I'm a guru all the way. But I built a robust framework around the business cycle and secular cycles. And so I have an analyst with me, Julian Bittel, who was ex-Pictet Asset Management. I think he's the best business cycle analyst in the world. He took my work and just 10x'd it. So we look at that, the nexus of the business cycle plus these big trends, the big secular trends, whether it's technology, whether it's places like India, or whether it's cryptocurrencies. We also look at the big debt demographic cycles that rule the world that we live in. We also have another writer with us, David Matten, who takes us on the deep dive of technology, because we're at the point of what I call the exponential age, which is where technology is going to move so fast and impact so many of us in everything that we do that we really need to all be on that journey as well. So that's what we try to do. Out of that, I probably write something like 130 pages once a month on a weekend. I don't know how I do it. I don't even take notes. Julian does all the charts and that side of things, and I just take what's in my head and put it down on paper, and I've been doing that for 20 years.
And how can people get at this information? I'm sure there's a trial, and then it's probably meant more for institutions and family offices, but maybe just explain more about your audience and how people can get that information.
So I have different ways of accessing my work. One is I'm very prolific on Twitter, so people can find me at Raoul GMI, where I give snippets of this out. I also have a podcast channel called Raoul Pal the Journeyman, where I do presentations, but also interview a lot of people. So those are the free parts. Then there's Real Vision itself. You can sign up to Real Vision for free. You'll see content for myself. But then there is a paid tier called the Pro Macro tier, of which I'm a large part of that myself and another macro research service. So that's when you start to see the written research and the outputs from me and the trade ideas. That's aimed at anybody who's kind of active in markets and wants to go a little bit further and to understand how markets work and how to have an investment framework and do that successfully. And then beyond that, it's Global Macro Investor, which is for people who have more considerable wealth because it's an expensive service. You know, it's for an individual, it's $17,000, $18,000 a year. So it becomes much more expensive. So you need a level of sophistication or a level of wealth to justify it. But the Pro Macro is where you get most of my research, but you can also find free. So I try and help as many people as possible from all of this work that I've done over the years and just spread it around. Different people get different access points.
Okay, that's great. Well, once again, I give it a plug. It's excellent work. And
if people aren't Real Vision members, that's probably the best place to go. Just sign up for Real Vision. It's free, realvision.com. And then you'll see from there the various different product offerings to find what you need. There's even education stuff, education academies, all sorts of stuff.
And for those who are listening in, and this is recorded and will be shared with many other people in our network, explain to them what Real Vision even is and how it started and what is it all about?
Real Vision came out of the financial crisis and then the European crisis. You know, I have been at the epicenter of the financial system my whole life. You know, working for a giant hedge fund and working for Goldman Sachs is about as epicenter as you can get. You get all the information, and by the time it gets to ordinary people get nothing. Even, you know, investment advisors got so little compared to what a trading desk at Goldman would get. And the financial crisis plus the European sovereign crisis taught people that they need to educate themselves. They need to help take control of their finances. They need independent people advising them, people that aren't just at the epicenter of the system. You know, that's why the business that you've grown, Dave, has been great, because people want a trusted source that's outside of this kind of big financial system. And so I was trying to think how to solve this, because my research was too expensive for most people. Twitter didn't exist when I started. YouTube had just started. I thought, do I write a newsletter? I thought that's not the right answer. And we started to try video. Maybe I could give ordinary people access to the world's most famous hedge fund managers, analysts and investment strategists. And then they're getting the same information. And so we launched the first financial video site. We did the first ever long-form finance interviews. And we started kind of by word of mouth, and it's grown ever since. So now it's not just interviews and presentations. It's also written research. It's a global community of people in 120 countries around the world, connected, talking to each other, meeting each other. It's a live events business. We have education on the platform. It's really now the super community of finance built on the super platform of finance. We have AI integrations to help people level the playing field again. You don't have to listen to somebody explaining, talking about the reverse repo, and you're like, well, what is this? Just put it into the AI and it'll explain it. It'll summarize stuff. The community starts sharing trade ideas, all sorts of things. So really, it's a place for us to go, to feel comfortable, to learn, and to think about how we can manage our future, because that's what we're all in the business of, is managing people's futures, because we all have an expectation of our future selves, and our job is to try and make sure they get there. You're doing the same thing that we're doing, you're just doing it in different ways.
Yeah, no, I just wanted to go back to what you said earlier. The credit crisis was a turning point, not only obviously for the financial market, but for investors, just sort of financial acumen. Things changed in 2007 to 2009. I'll never forget. Prior to that, and this sounds a little glib, we really didn't have to communicate that much to clients. They just trusted us. We would go ahead. We would take our discretionary authority and manage the money as best we could. That trust almost got thrown out the window during the credit crisis, because they saw the markets just back up so incredibly. I think the S&P 500 was down 58% over a short period of time. And our clients especially started demanding more information. So for we were a smaller shop back then. Instead of putting out sort of a quarterly commentary, which was a lot of jargon and a lot of the same stuff you see everywhere, we changed it up tremendously. And Joe started doing a monthly commentary that's much more friendly and folksy. And then Ken Reed started doing a weekly one called the Weekly Beacon that hits some hot topics. And so our clients really, there's no way they can get through it all unless they're completely retired and have a lot of time in their hands. And so that was I noticed the real changing point was 2007. And so you just spotted that as well in how your work changed so tremendously. So I just wanted to reinforce that.
And also,
statement.
Dave, there's another interesting thing that came out of that. So there's basically two cohorts that got really affected. One with the older cohort, the baby boom generation, or the older Gen Xers. It kind of very much shocked them that they thought they could trust the system, and the system now was not trustworthy. The others were the millennials, who were at university or finishing school when all this started happening. And so they just completely lost trust before they even got into the system. So Occupy Wall Street was a function of that. They were angry because their future had been robbed from them by the largesse of Wall Street, the debts, and all of the things that had happened. Now, that cohort of people, young people, they didn't invest all the way through their 20s. They weren't interested in financial markets. They thought it was terrible. And then COVID came, and suddenly they all came into the financial markets. So now we've got a new group of people that we have to address and help. They're also scarred from 2008. So, it is part of all of our jobs to realize that, is that, not only do we have a fiduciary duty, but we have a duty to help people navigate this in a way that they feel heard and also trusted.
Yeah, no, I agree. I'm going to pass it over to Joe with any questions. Joe's got a background. He takes care of our alternative asset program, but prior to working with us, he worked at several other investment firms. And one thing in particular that Joe has in common with Ross Healy, who is also a portfolio manager with us, is they both taught. And I think teachers are excellent in this business because they understand how to get messages across to people that are understanding to that level. So, Joe, take it away with any questions or comments you might have to Raoul.
Yeah, absolutely. Thank you. I'm also married to a teacher, and the one thing I can tell you about teachers is if you do something wrong, they make you do it over again. Um, Raul, it's great to see you again. Love what you're doing, and obviously we're big fans and investors. I have a couple of questions. One is on Solana. I know you like Solana. I think it recently passed Ripple. Do you see it kind of overtaking Ethereum in the next little bit of time? So that would be one kind of specific question, and then a broader question is these new DPINs, the decentralized physical infrastructure network projects that we're starting to hear about, like HiveNapper and Helium. That's sort of a new area. So maybe one would be where do you see Solana ultimately going, and what even are these DPIN things?
Yeah, so Solana, to level set for people watching this who may not be so familiar with cryptocurrencies, if you think of cryptocurrency, blockchain technology as a new layer to the internet that introduces digital scarcity. It's a ledger system that allows the recording, ownership, and settlement of things. Within it are a bunch of distributed businesses. One is Bitcoin, one is Ethereum, one is Solana, and they sell block space. They sell their ledger, like AWS and Azure and Cloudflare sell cloud services. They sell this ledger. So different ones have different use cases or different marketing messaging. Bitcoin, the secure one. We use that for certain things, like could we use a system of money or store of value? Ethereum has been the broad kind of, it's kind of like the Android operating system. It's a huge system of which anybody can build on top of, and it has a lot of traction. Solana's actually more like Apple. It's a single ecosystem, but it's very fast, very efficient, very nice. So there's these different things. The question is, at a broader level, Joe, is what's going to win? And the answer is, I don't know. What we do know is it's a very narrative-driven space, and Solana has had the narrative, and it's been growing very fast because it's fast and cheap and seems very suitable to end-use cases for retail users and others. I think that continues. It continues, and it should really flourish. And then the introduction of Firedancer, which makes it incredibly fast, means that it could be used for the financial system for executing trades like NASDAQ. Okay, so that continues to grow. Ethereum lost its narrative a bit. Why? Because it's a bit complicated. Because you've got Ethereum itself as called a layer 1, and then you've got these other chains that make it faster that are called layer 2s, but they all kind of integrate in something called the Ethereum virtual machine, which is the operating system. And then there's lots of things like DeFi and DP and all of these things. A lot of these are being built on Ethereum. So I just think they're two different things. If I listen to Larry Fink and the financial system, think of how risk averse those people are. If they're going to build on this tech stack, which they are, they will probably build on Ethereum because they know that they can integrate. They can use all these different layer 2s and they can talk to the layer 1, the settlement layer. It's all been road tested for a while and it's not perfect. Solana will eat into some of its market share because it's better for other things. Maybe when the Web 2 businesses like Meta or Meta or Google or others roll out into Web 3, they'll use Solana because it's really suited for that. So how I think about this space really is it's not an either or. Our job is to get this trade right because this is the biggest trade in all history. So far, Bitcoin is the greatest performing asset of all time, and that's only been in 12 years. It's 22.5 million%. It does 150% a year returns, and that includes 4 80% drawdowns. Ethereum's actually does even higher returns, about 170, and Solana's currently about 240% returns. So this is unbelievable returns. But really, for people watching this, just think of this. It's a $2.5 trillion asset class. investing in this new technology stack. By the end of this business cycle, it's probably 10 to 15 trillion. Okay, that's starting to get around gold size. It's going to 100 trillion. That's just extrapolating the growth. It's growing at twice the speed of the internet. So if that's the case, then going from 2.5 trillion to 100 trillion by, I think, 2032, maybe 2034, means that this is the largest, fastest accumulation of wealth in all human history. So our job is just to participate sensibly in that growth. And so I try, yes, me, because I'm an asset allocator, I know how to do this, I'll look at switching around. But for most people, just own a spread of this stuff, the top tier tokens, and let the trade play out, I think is how I think about it.
Yeah, no, good answer. And I like the way you said. You basically said, Solana is probably the one that's rolled into 24 on a great deal of momentum, and it's surging forward. But you're also saying, well, but if you have XRP, don't start dumping it right now. So I really like the way you approach it. Maybe just one more question from myself, and then I'll pass it over to David.
I need to answer your deeping question as well. I'll come on to that in a sec.
Yeah. We'll get to that for sure. In your book, Adventures in Crypto, I really like the sort of empowerment angle that you approach that. How do you see that growing and evolving? Because with the growth, there's also a lot of bad actors, a lot of fraudulent activity. Where do you see that balance today versus maybe 5 years ago?
So, in terms of inclusion and what this really means, again, think of that 2.5 trillion to 100 trillion. This is literally going to change the lives of billions of people. And unlike the internet, we couldn't invest in the internet. You have to invest in Google shares. If you're in India or the Philippines or anywhere, you couldn't do that. Here we have a global homogeneous investment product, these tokens. They're available to anybody in the world with a mobile connection. They're fractionalizable, so each of us can put in 10% of our paycheck. So we're now on a level playing field. Right? One of the things about Occupy Wall Street was the bankers got rich, the rich got rich, the poor got poorer. All of this solves it. And there's a huge amount of wealth to come. So it's incredibly egalitarian. Now, any frontier where wealth is being generated will bring about hucksters, frauds. Just think of the United States or Canada in its early days. Right? There's always this. It's the same with the internet. Now, the job is for most people to just be sensible, keep out of the way of all of that noise and not try and chase the big idea, because often these things aren't right. Just if you were to just hold the top 5 tokens and go to the beach for 5 years, you'll do fine. And you would have none of the exposure to frauds and scams or anything else. So that's how I think about it. We're our own worst enemies in this. Of course, a lot of money, a fast-going space is going to attract all types of players. Just be the level-headed player who realizes I can make life-changing wealth just by getting it right.
Right.
Yeah, no, that's great, Joe. And I'm going to jump back in. We've just finished an investment with a company. I'll leave it nameless just because I might I might give it some shots here. It was a company that was ahead of its time, and it was the first public access to Bitcoin and Ethereum in Canada, and I'm fairly sure the Americans followed suit, and now it's available through ETFs and so forth. And we waited forever for this company to come to fruition, and then it finally did. And within 6 months, it went from zero under management to $2 billion in 6 months. Just incredible at a 2% management fee. So we're very proud with that. And then we decided, it's time for us to get our private investment out, only to find out that I'll just blame it on the senior management, had structured it such that we couldn't. We had to actually get out after them. It was totally the opposite of any public vehicle or anything. And this is all in just my personal opinion. I'll really put that in just to protect ourselves here. And so that was a real wake-up call that when you invest in private companies, they're not treated the same as public companies. They're not under the same scrutiny, and they can protect themselves as at the top of the pyramid. Now, so learning all of that, and we're out. We actually still had a half-decent return at the end, so we're not too bitter. But it really woke us up to the fact that certain privates, and then we've even seen it in certain in the crypto space, where you can have the promoters and the people who started it all of a sudden starting to issue more coins. And this happened in. I'm starting to show my my lack of knowledge in this space, because I know this has happened in the past. How is it being? How is the system corrected for that now? I know the Ethereums and the Bitcoins of the world are very safe and closed-end loops, but how do all these other top 5 coins, as you call them, how do they protect ourselves so that's not going to happen to investors?
Well, anything that's large has been somewhat battle tested. It has a very clear white paper. It tells you what the emission schedule is. Everyone knows who the holders are. So most of that is very clear. It's when you get involved in smaller stuff with teams you don't know, that have not been road tested, that maybe aren't regulatory compliant, that's when you run into difficulties. So look, VC in the space is very rewarding, but you need a lot of skill set. And the best thing is, partnering with the right people to do that. It's the same with the hedge fund space that I'm involved with this. It's complicated, but if you get the right hedge funds, you get to capture the right trend. So I definitely think the opportunity is there. Not everybody's going to get everything right, but a VC style structure is probably the way to approach it, where, look, 1 or 2, they're not going to work, but 1 or 2 are going to be worth $10 billion plus. And that's, I think, how to approach it.
Now, that's a good foray into what you're doing with, I think it's a relatively new fund in the crypto space. And we talked a little bit about that on the last webinar together. Maybe just to explain where it's at now and how that's working with the managers you're working with.
Yeah, so Exponential Age Asset Management, we have a fund called Exponential Age Digital Asset Fund. And what it is if you think of that trend, 2.5 trillion to 100 trillion, it's what we think is the best way for people to capture that trend and not worry about it. Because it's not going to be Bitcoin, Solana, and Ethereum that capture all of the value. There's going to be a lot that captures this $100 trillion of value. So the idea that we had was to create a fund of hedge funds that only invest in crypto tokens and find the best managers in the world and let them navigate the returns of the space. And so that's what we've done. We've got a portfolio of 14 of the best managers, and their job is to find the opportunities in the space and allow our investors to capture this opportunity. And I mean, luckily last year we were the best performing fund in the world, having a good year this year, but really it's the crypto beta cycle which we're trying to capture. We also use a top-down macro framework as well that I've developed to help us navigate the cyclicality. We're not trying to eliminate it entirely, but just dampen it on the downside when that comes. And it's been going really well. I mean, I've just been around Australia speaking to wealth managers in Australia, where 20% of our investors are actually based there. Very similar to the Canadian audience, entrepreneurs, property developers, people like that, mining people, and they find it a nice way of diversifying and also avoiding the kind of debasement of currency from the endless printing of money. So, yeah, it's been a really successful journey so far. We've got an amazing team, and we found some incredible managers.
Good. Well, I'm glad to hear it's progressing, and we'll be talking more about that. Let's talk about some of the usages of blockchain technology, and they're endless, really, from corporations keeping track of their assets to Bitcoin, of course, is the ultimate in blockchain technology, a lockdown system where only so many units are issued, and it's finite. It can't be infinite like the fiat government currencies that exist, or somewhat infinite. Here's one platform that I think it's going to really help us out in Canada, and you're probably not aware of this, so let me just give you a little bit of background. So we have a venture exchange in Canada called the TSX, S&P TSX Venture Exchange, and it's where the smallest companies and the microcap companies go to go public, because it's one of the lower cost entry points. And over the last 10 years, the annual return of that venture exchange is negative 5.7%. It's almost down 6%
Wow.
annualized over the last 10 years. It's just been horrendous. And compare that to our big board in Canada is up over 7.5% over the last 10 years. The S&P is up almost 13% over the last 10 years. The NASDAQ up 16, and so on. So it's the worst performing platform on the planet, and people continue to put money into it, hoping that it's going to change. And my question of bringing it up is, if there was a way to track the actual ownership of the shares like you used to be able to with a proper share registry, those don't really exist anymore because it's held all over the place, the ownership, but have some sort of a blockchain when a company issues their shares, and so they know that each share is coded so that you can tell exactly who your ownership list is. And then more importantly, when groups and institutions go to short it, they literally have to do a proper borrow. They can't go and do what's called naked shorting, and that's another whole podcast, naked shorting. But tell us, like, do you know where I'm getting at here? Like,
Yeah,
how
I
that
do.
could help
And-
a stock system like this?
So a stock system like that, firstly, think of settlement. It's probably T plus 2, T plus 3, I don't know what it is.
Yeah, T plus one in Canada as
T
well.
plus 1,
Yeah.
well, it'll be T plus 2 minutes on blockchain rails. The other thing we moved away from is, many years ago, shares were bearer, i.e., when you bought a share, you physically owned the share. Now it's held by nominees and all of this other stuff. So you don't know what the custodian is doing with those shares. As you say, they allow stock borrow, stock lending, that kind of stuff on the shares. If you are the bearer of them because it's on a smart contract, then you get the choice on everything. So you are now in control of your own shares. The blockchain makes it transparent to see who's doing what, so there's no shenanigans. You know, we've seen that with a lot of small companies. There's shenanigans. You want to know who's doing it. We can see this in crypto. Often when there's kind of some scam project, there's some great person who goes to the blockchain and goes, okay, well, these guys are dumping the tokens and these guys are doing that. You can see it. You can see the market structure better. So it's more efficient. You get to own what you purchase. You get to give rights to, if you want to lend it out because you want to get some extra income from it, that's fine. And the market gets to understand the market structure. So it's a much more efficient system. And because it's then on a distributed ledger, let's say there's another financial crisis, well, there's less weak links in the chain because it's not all daisy chained together. So I have always held the opinion that the whole financial system will go this way, because it's just a better, more efficient, faster, more secure way of knowing who owns what.
So that's a great summary for everybody, but there's going to be participants in the system that aren't going to be very happy with this because of the revenues that they're going to be foregoing. There's going to be the banks, there's going to be the brokerage firms, both cross-border brokerage firms, and they're the strongest lobbying powers in the structures. Like, how is this very smart solution going to get through that barricade?
So this space has been driven by passion of the incredible smart people all across the world who are involved in it. And because there's an incentivization to bring more people onto the networks because the value of these networks goes up and people participate, it is very hard to stop. So the financial system may try and fight it, but it's very hard because we've just seen in the US the political flip-flop that's just happened, because suddenly they realize 50 million voters really care about their pocketbook and their crypto investors. Suddenly they change. Suddenly BlackRock starts thinking, we can use this because BlackRock builds on top of the existing infrastructure. they're big enough to bully and say, well, we don't need all of these guys. The DTCC and Euroclear and the exchanges, can we do this ourselves? Can we change how the system operates? Do we need the SWIFT payment system where somebody's making money out of our transfers because it takes so long and we don't get paid the interest? So they start looking at this, and because they're a low margin provider but high volume, it's like Amazon. It's a relentless driving down of costs, so they force it to happen. It's like Amazon will force robots into the workforce, and they have done, because this is their business model. So I don't think there's anything anybody can really do about it over time, because it saves people a lot of money by using it. So we will see an adaptation from other players. We have to.
Okay, final question. You triggered me on something there, and then I'll pass it back to Joe. Politics, we don't ever get into politics. We try to be apolitical. It doesn't make any sense for us as money managers to try to choose sides. But of course, we still can't ignore the whole thing. And I saw something the other day, and I'm wondering if this was fake news or what, where Biden came out with an executive order saying that he was doing away with cryptos. And now, is this someone playing games, or that I just got on a bad feed? Is there a chance that they have made approvals in the U.S. for ETFs for all the various, or for many of the cryptos, starting with Bitcoin and now Ethereum? Is there some truth that the government can just come in and just stop all that?
So what had happened? I mean, there's a legal system in the US, so you can go through the courts, which is why Ethereum and all these things start getting approved. So that's one side, the checks and balances of how most of our systems work. But what did happen is Congress passed a vote about a new set of crypto regulations, including a bunch of Democrats. So it was bipartisan, and then Biden vetoed it at the last minute.
Okay, that's what I heard.
And nobody's sure what the hell was going on there. But on the other hand, we're picking up signals from the Democrat Party that they are actively entertaining the crypto community now to start to listen finally. The crypto community is very angry with how they've been treated. They've had to do everything through the courts. It's cost billions of dollars to get to where we are today. So what we found is Trump on the other side has realized, he's very astute when it comes to where the voters are. He's like, well, I'm just going to embrace these guys and see if I can win those voters. So they've actually become a marginal, maybe a key player in how to swing the vote. So I don't know why Biden vetoed it. We'll find out more. But from what I hear from around all of the edges is that everybody's realizing that there is no point. You're never going to win an election by fighting people's wealth. If you're saying you can't participate in the biggest wealth generating opportunity in history, that is not the way to get elected. In fact, it's the way to get people on the streets. And I think people are suddenly realizing this. I mean, there's a lot of the size of the opportunity set from this space is too big not to give people access to. If you allow it to just accrue to Goldman and JP Morgan and BlackRock, and individuals don't do it, I mean, they'll burn the place down. So I think politicians realize that.
Good. Let's keep it apolitical. I like that response. Joe, back to you.
Yeah, let's jump back to these D-pins and just sort of talk about what they are. And is that more of a cost thing, do you think, or more of a privacy thing with the infrastructure?
So it's just a more efficient way of doing things, because what you're doing is creating an incentive system inherent within a network. So let's talk about one that everybody can understand, Uber. Uber is a network of drivers that Uber takes whatever percentage share, 40% or 50%, whatever the number is, for implementing the technology and routing all of the orders to the drivers. The drivers use their own cars, etc. Now, as Uber succeeds, these drivers don't get rewarded. They just get their paycheck. But the Uber managers and shareholders get rich. DPIN allows you to use a token for that, and token values the network itself. And so therefore, imagine if you're an Uber driver getting paid either in tokens or in cash, but those tokens that you're given or awarded for your work also go up in value. Now you've changed the entire lives of Uber drivers by sharing the economic value. It also makes it more robust in how things manage. So now I'm thinking about stuff like Helium. Helium is a distributed mobile phone network or Wi-Fi network where I can set up a dish and then anybody around me can use it, and if they use it, I get paid. So much like if I use my Wi-Fi, I'm going to my telco provider and I'm paying them for the use of the data, well, they pay me. So if you're walking past and you're using mine on your mobile phone, I get paid a few cents in tokens. Okay, so this is really interesting. It's the same with HiveMapper. HiveMapper is, well, Google sent out tens of thousands of drivers or hundreds of thousands of drivers around the world and got them to take video and map out the world. HiveMapper says, well, you don't need to do that. Just let individuals do it and reward them for it. So they become your entire network. And so you know, an Uber driver just sticks the HiveMapper on their car, it maps everything, and they get paid for mapping it. And so this is what this decentralized infrastructure can do. I also think we'll see it from logistics chains. We'll see it from all sorts of different parts. We will see it with, can we rent out our digital ID? So why should Google make all the advertising revenue of stuff that I look at? What happens if I look at a BMW ad and I get paid a token for doing it? Okay, it's this understanding of incentives and how you can share them more fairly that I think really helps. And it also creates robust networks. Now, the whole Google Maps network would go down if Google shut down or whatever happened, right? Or China banned them or whatever it is. But when you've got HiveMapper, it's a distributed network that only one part of it can, you know, the guy in Minnesota driving around, well, if his car goes down, it doesn't matter. It's decentralized. So it's really, they're really interesting. It really is the future. It creates a lot of opportunities in ways we don't yet understand.
Okay, really good, really good. And then just some of the, you know, I know with crypto, not to be negative, but back to some of the frauds that we've seen, you know, is that for the top five, you know, the Ripples, Solanas, Bitcoins, and Ethers of the world, you know, is that less likely to continue because, you know, the way I think about it is decentralized means essentially more private, but, you know, I just sometimes struggle with the notion of, well, everything's on this distributed ledger, yet there's a privacy argument too.
There's no privacy in a blockchain world.
Yeah.
Right, because every transaction is monitorable by everybody.
Right.
Where things, and you know, if we talk about where things go wrong, it's not usually at those big blockchain levels, because they've got thousands of nodes and thousands of developers and thousands of people. It's at the businesses that get built on top, the applications. It's the blockchains of the underlying technology, like the internet. It's who's building businesses on top, where they don't do things correctly. FTX would be the biggest example of a fraud that's building on top of blockchain technology to do stuff. So, yeah, I don't really worry about that. Privacy, people talk about privacy. None of us have it. The government can go to your bank account, freeze it. Your mobile phone tells you where you are at any one stage, reporting it back to Google or Apple. Google knows everything you've ever looked at on the internet. And then CCTV cameras, everything else, even your car tells you where you are. So I don't know where this privacy is. People say, well, cash, that's privacy. How much cash does anybody carry around? I basically use cash for a valet parking and not even to tip the hairdresser. That's it. I don't even use cash anymore. But you don't do most transactions in cash. So, yeah, I think the balance of having the openness of the blockchain that we talked about before is probably better than the loss of privacy of transferring money around.
Got it.
But nobody
Okay,
wants
good.
to. But you don't want people to look in your bank account either. So you have to keep some level of privacy. You can do that. They don't need to know it's you. You just need
Yeah.
to make sure that you disguise yourself. Now, an enforcement agency can figure that out very fast, but you don't want people to look in your bank account and say, oh, Joe's worth this much money, or whatever it was, or Joe spent this much on his car. That's not other people's business.
Yeah, I think that's a great answer and a great way to think about it. Just maybe shifting gears to the environmental side. We get all kinds of information about electric vehicles, energy usage, the electrical grid. And I noticed Digiconomist has now a Bitcoin energy consumption index that's on the internet, so you can actually track energy consumption. At some point, as this area grows, do you see the energy consumption side of it being like a barrier or like a ceiling to further growth?
No. I mean, what we've found with Bitcoin's been really interesting. You remember, like 3 years ago, it was all about, oh my God, this is terrible technology because it's using too much electricity and it's polluting the world. And then what they realized is Bitcoin miners are economic actors. Their job is literally to find the cheapest cost of energy. The cheapest cost of energy happens to be geothermal, solar, and wind. So they have piled investment into those areas because they don't need a power grid. They just need localized power. Right, so the reason solar and wind and all of these are struggling to scale at massive scale is because you need to plug them into an entire grid. But when you're doing it localized, like many people run their houses on all of this stuff, it works. So they found out that actually, I think it's like 60 or 70% now of all Bitcoin mining is actually green. They're using gas flare-offs in Texas. So that's wasted burning of gas they then use to create electricity. So it's really interesting. And if we've got a big electricity problem coming or energy problem coming, it's AI and the data centers. They're much bigger.
Right.
The computational power needed for that is staggering. And that will open up, again, another push towards renewables because they want to do it as cheaply as possible and localized. They won't call off the giant grid. And then we will see the rise of nuclear. We've already seen Microsoft investing, as have OpenAI, in these small nuclear plants that are distributed. So you can put it next to the data center, and then you've got almost endless free electricity.
Right. Okay, good.
I'll jump back in, Joe. Just keeping it, going back to the macro side, governments around the world are heavily in debt. It's almost a race to see who can create more debt than the other one, and that's sort of their war games against each other. It's all debt, but they're obviously trying to do what they think to better their countries. But what could happen down the road? Could governments around the world, you see El Salvador already do it, by the way, get into Bitcoin for a small nation like that, and in the short run that seemed like a very good solution. What about the larger countries around the world? Could you see them creating their own type of crypto coin that's finite and not endless like they have right now? Where do you see that going?
If you were king of your country, you would want the ability to print money.
Yeah.
Right? You're just not going to give that away. So you live in Canada, you have to use Canadian dollars, and you operate within that system. You pay your taxes in dollars, you pay for your services in Canadian dollars. So there's no way around that. So how do you solve the debt problem, this gigantic debt problem in this aging population? Well, that's driven by the robots, the AI, the infinite number of humans you can create that can create vast economic growth. I think we'll grow ourselves out of this. I know it feels impossible now, but in 5 or 6 years' time, you'll see how much AI has changed the world and how much having almost infinite robots. Don't forget, Amazon now employs the same number of robots as it does humans. And that's happened in 4 years. So it's got I think it's got 1 million robots now. And it'll be 2 million and 5 million and 10 million because they're so efficient. So it's a deflationary force, but B, it changes productivity and changes trend rate of growth. So I think we will get out of this mess, but we're going to end up still printing money for a while to keep going, which is why cryptocurrency, on the other hand, does really well to avoid the debasement of currency. Because the hurdle rate for everybody, and again, very important for your clients and investors to understand, is that if the central banks around the world are printing money at 8% a year and inflation's another 4% on top, that's a 12% hurdle rate. So just investing in the TSX, you're actually losing money. Now, Canadians know this because the property market outperforms. And that's because it's driven by debasement and scarcity. That double whammy is an incredible thing. And people have to take on more and more debt because incomes only go up with GDP growth. And if they invest in the stock market to think they're going to get ahead, they still can't afford the house that they want to buy. You know, these are the issues with debasement. You have to figure out how to get ahead. And again, the rich get to own the assets that really go up in price, and everybody else gets shut out, which again is something that crypto solves.
Interesting. Okay, Joe, back to you.
Yeah, just coming back to some of the more regional stuff. There was a California judge who I think opined on a Ripple lawsuit. Do you have a sense of how, like they say, the individual U.S. states are more powerful than the United States as a whole at the federal level? Do you see that from your perspective, individual states like California, for example, being more open to cryptocurrencies and other states not? The company David alluded to earlier that we were investors in, that we sold, it was to a Japanese group, and you know, we understand that the Japanese are more accepting and more open and more likely to use crypto. Is there sort of a national or international difference around the world?
There is. There's difference at state levels, like Texas, Florida. You know, there's places that have really tried to embrace it. Wyoming. There are places like New York that have been slow.
Yeah.
That's politics. We saw this with the cannabis industry as well, right?
Sure.
You couldn't get federal approval. Different states had approval. You know, you guys in Canada got the full approval. When I look around the world, generally speaking, the Europeans have done a decent job. The UK is just trying to finalise it. The banking system's the problem there. Swiss have done a fantastic job. Singapore's done a good job. Hong Kong, Dubai, they're all in place. Japan is in place. The US is still dragging its heels. And partly it's because it doesn't know what to do. A, it's a government run by 75-year-olds or 80-year-olds. So they don't understand and they fear change. And secondly, they're the world's reserve currency. The payment system, SWIFT, is theirs. The Eurodollar market, the global lending market, is theirs. So, you know, small changes can lead to very unintended consequences. So I think they're just cognizant of that, which is what makes them a little bit scared.
So are these like the growth areas then, or the opportunity areas? You talked about New York, or is it more like you know, just forget it and eventually they'll come around to it, or how do you look at those areas?
Again, the genius of this is it doesn't matter for us because we can own the tokens, and then when New York comes around and it's more embedded in the system, the more
Right.
people come on, the more the value of the network goes up. So right now, India is partly on. They've got the most number of crypto users, but they're really restricted because India has capital controls. So they're trying to introduce a central bank digital currency so then they can open up to this whole world. So what it does, it brings on a ton more people onto the network goes up. China shut it down for the same reason, capital controls. because they need to get on a central bank digital currency, record what money people have got, then they can allow it to happen. So over time, the number go up as more people come into the network.
Okay.
And the more the price goes up, the more it forces somebody like New York to re-regulate because their voters want it. You know, it's this very virtuous circle. It's really interesting how behaviorally it works so well.
Right. Okay. I didn't think about that. Okay. Good.
I'm going to jump in with my final question and then try to go to some of the questions that are being written in here. So I don't know what your portfolio looks like, Raoul. I don't know how much, you don't have to tell us, how much you have in publics and privates and crypto and so forth. But we've been on one of the greatest runs ever, some people say since 1981 for the markets. More realistic people say since 2009, this incredible wave that's happened in the public markets, and then now crypto is sort of the replacement for the year 2000 of investing in the internet. How do you hedge against the inevitable decline that is around the corner, but no one knows when that is?
I don't. And the reason being is the entire infrastructure of global government and global central banks, one thing is to not let the price of collateral fall too far. So that is the price of assets. What they do is the moment something bad happens, they print money. Printing money means that the value of the denominator goes down and the value of the asset optically goes up. Now, if you think, what is a debt deflation? That's when things get bad, right? 2008, debt deflation. What was happening is your debts are here, the value of your collateral gets too low and everyone calls on the collateral. In 2008, there were lots of claims on the collateral as well. Now, what they learned from that is if they print, it raises the cost of collateral. They did it in the pandemic. Everybody did it. And hey presto, the biggest economic event to hit the world, when everybody shut down, disappeared in 1 quarter. It's amazing. So I don't worry about it. I think we've removed the left tail risk. Of course, we have the business cycle. We have ups and downs of markets. But I don't fear the big event. I think the fear of the big event is the one thing that holds most investors back. From the two mega secular trends of technology and cryptocurrency. And arguably cryptocurrency is just a technology trend. But that mega trend, what I ask myself is, will tomorrow be more digital than today? If that answer is yes, keep going. And people throw back at you, yeah, but look at 2001. Look what happened. Well, I've been in crypto for a while. Last time I checked, I've gone through 3 down 85% markets. Yet, the market is up 350,000% since I first started investing in the space. That's with the drawdowns. Last time I checked, Amazon went down 98% in 2000. Last time I checked, it's the 3rd largest company in the world. So, it's time horizon. It's time horizon and a secular trend. Get rid of almost all sins. And then when you've got a central bank whose job is to print money, which is their new trick, okay, that makes it the greatest risk-taking environment of all time. That's my view.
Okay, and what time horizon?
So in answer to that, Dave, I am unbelievably far out of the risk curve. I am basically 100% cryptocurrency of my liquid net worth between the hedge funds and my own portfolio, investing in the fund and my own portfolio. And I'm very comfortable with that because I spend a lot of time in the space. I do a lot of work on it. I understand the macro that drives it, the liquidity cycle, and the adoption of the technology.
And what about for your parents? Like, how would you position their portfolio if, they're obviously a generation older than you?
Yeah, you see, it's weird for me, and I'm trying to get my head around this because I'm European and everybody bought bonds. So, I forced my dad to buy bonds and it was fine, But that world doesn't work anymore. So I kind of struggle because I always hated the idea that pensioners should own equities, but I don't see a way around it. Now, you can find yield plays, there are ways with alternatives. there's ways with the kind of real estate stuff, but I do think they need to own something with some risk, because if not, if they live, let's say they're 73 now, they've retired, and they're going to live till they're 90, you need to maintain the purchasing power of your nest egg. It's important. Now, you spend less as you get older, so it's not the end of the world, but you just need to do that. So just owning a bit of NASDAQ helps. If tomorrow's going to be more digital than today, the NASDAQ will do fine over time.
Right.
Just, it doesn't have to be cryptocurrency or anything else. It's just, you need to have a little bit of that risk bucket that's going to help cover that. And then that can offset against the income bucket that will be obviously less accretive to your future wealth. It's more about current consumption.
Okay, I can't believe how quickly 60 minutes has gone by.
know.
Let's do a few of these questions that have been written in, and then we'll sign off here. So here's one from the chat from one of the listeners today. If one has 100,000 latent in cash, how would you advise these funds to be allocated? Buy and hold 5+ years, the top 3 to 5 cryptocurrencies? Question mark.
I would start by buying Bitcoin, Solana, and ETH equally weighted. You're making no decision there. By you doing that, you will start watching content, reading content, learning. You'll find other opportunities. But, personally, I keep saying to people the best way to do this is do something like that. And then if you want to play around with 10% of your portfolio and other stuff when you're learning. But yes, I would just, we're currently having a nice correction. Perfect time to add. And if you've got a 5-year plus time horizon, remember that. Write it down. Because when the market's miserable and it's fallen 70%, but from a much higher high, you'll be starting to panic. And you need to tell yourself, write on a bit of paper, when that moment happens, that's when I need to buy more. Mm-hmm. Buying more on the cyclical downturns in a secular trend is how to compound wealth faster than any other way I know.
Yeah. Okay, that's good advice. Here's another one from a younger investor. Is it investors using markets like a casino now, or is it behavioral change for young consumers?
I think it's both, and there is a rational reason for it. So let's say you're a 35-year-old. You're probably just thinking about getting married. You might have kids now. You're thinking of school fees. You've now got retirement. You've got to buy a house that's enough for a family. And if you remember, house prices are unaffordable for most. You've been told to invest in your pension plan, and you do that. If you're an American, you put your 401k in every 2 weeks, usually in passive funds, which you were told to because they were cheap. But what you find is, because of the debasement of currency, you're not getting ahead. So 2020 and the stimulus checks gave people free chance of learning about speculating. In the good and the bad sense of speculating. And they have learned that they can speculate or invest in high risk, high return markets. And if they get it right, it can change their outcome. They're not doing it with all their money. They're doing their 401k. They're trying to get in their house, everything else, but there's no way of them getting ahead. So we've changed the behavior of markets because we've brought in this gigantic cohort of millennials, and they have different needs to us. They didn't work for a big company their whole career and accrue a pension and get this raising salaries. Most people are now having 2 or 3 different jobs. It's a very, very different world than the one, Dave, you and I grew up with. That life rarely exists anymore. And so the only way for them to get ahead is by doing this. And I think it's probably right. It's better that than the baby boom generation and the Gen Xers spending in the US $110 billion a year on lottery tickets. That's terrible.
Okay, final ones from a gentleman named Martin here, last names. Which platform do you think is best to purchase, most secure, crypto?
The easiest answer is Coinbase. the biggest. It's basically a monopoly. I mean, I use Kraken as well, which I like. But Coinbase, again, just trying to make it easy for people. Coinbase is a giant. It is a listed company. It works very well. They've been going since 2011.
Okay, and that's great. Finally, what impact do you foresee decentralized finance, DeFi, having on traditional financial systems in the next 5 years, and how can traditional institutions adapt to this changing landscape?
So I'm seeing traditional institutions putting their capital into DeFi protocols. So they're giving 50 million bucks into a liquidity pool of a thing. So they're involved in the lending and borrowing. So they're very interested in this. I've seen big firms like Apollo doing this. So that's very common. I see the big hedge funds do it, all sorts of stuff. DeFi itself is very powerful. I mean, we've got decentralized exchanges. We think about the TSX or the NASDAQ or whatever. What a pain that is. I mean, now we've got decentralized versions of this where nobody owns it and it just works with automated market makers driven by algorithms. The power of this is, again, profound. Yes, they will fight it. The big problem with it is the inability to KYC a lot of stuff. But people are trying to solve that. Because, look, if you live in the Western world, you are going to have to KYC, so you can't get around that. So they just have to build KYC compliance within these decentralized protocols, which they will do. The financial system is building fully KYC compliant decentralized protocols for the financial system itself. So then their clients can be involved with the KYC. So it's interesting, it's growing, and it will keep growing.
Well, KYC is a word that means know your client, for those who don't understand that acronym. And Joe and I and Ken and the rest of our team deal with it every day. Probably 40% of our days are taken up with know your client forums.
Isn't that so? Dave, isn't that a ridiculous thing that can be solved by blockchain? I should be able to pass you a token that does all of my anti-money laundering, all my KYC, and you know that it's verifiable, and we can do this instantaneously. The cost, I mean, I live in the Cayman Islands, because it's a zero tax regime and everybody uses it as a tax jurisdiction, we have to comply with everything and everybody. So, just the amount of times I have to fill out this documentation, or you guys have to do the same, or collect it from your clients. I don't know how many thousands of hours that are involved. The cost per man hour that could be solved by blockchain is so easy to solve this.
Yeah. No, if we could get 40% of our time back on a week, imagine the amount of knowledge base we could dig into even more to enrich our clients. The regulators force it on us, in my cynical opinion, and this is my opinion. It's in our country, at least in Canada, it's the banks that are behind it. They want to slow up any sort of growth of independent firms like ours. They want to force us to work with them and to be part of their platforms. And there's a good subset of us who just will never do that. And so we'll have to put up with this. We're looking at electronic ways to do it, but those still aren't accepted by the regulators because we don't really know the client by them filling out a form. We're not asking them the questions face to face like this. So we're stuck with that in the meanwhile, but it will. I'm an optimist. It will get better. We will be able to get our sanity back and ultimately get better returns for our clients by having more of a knowledge base. Final question. A gentleman named Mark just wrote, do you agree with VanEck's targets on Bitcoin and Ethereum?
I can't remember what they are, but they're relatively high. And look, I'm pretty bullish. I think it's a bit of a fool's game to try and predict. I'm happier predicting the overall value of the space. I'm happy to say at some point Bitcoin will go to 1 million. What date that is, I don't know. I know the team at VanEck really well. They're good friends of mine. And I would say, yes, they're bullish. I don't disagree. But, I try not to put targets on stuff because it kind of messes with your head. You forget to take profits when you want to because it didn't get to my target. You get yourself wrong-footed really quick by having targets like that.
Yeah, yeah. No, we talk about behavioral finance every month. Joe does a piece in our commentary, and that old caveman brain of ours is always trying to kick in there and protect us. And there's no way to avoid that. So, yeah. Anyways, this has been wonderful, Raoul. Really appreciate the time. Yeah, we'll have to come down and visit you. And of course, if you're ever through Toronto, always think to look us up. And yeah, this has been great. This has been recorded. We'll share it back to the audience and to yourself, Raoul, and feel free to share it with your audience. And thanks a lot for your time
Fantastic.
today.
Thank you guys, as ever. Great to see you both.
Good to see
Okay,
you.
bye-bye now.